Hi, John Hutchinson here again with redirectmytaxes.com. And by the way, a lot of my friends and clients actually call me Hutch, so you can too. So welcome back to this course that was designed for business owners looking for business-sponsored opportunities. And before we go there, I want to just remind you about the opportunity and vision to be holding as you're going through all these videos. So we're looking for legal ways to avoid and shelter taxation using opportunities already existing in the tax code. And by doing so, hoping to compile substantial reserves to solidify your own retirement and estate plan. And last, wouldn't it be great to have some say as to which causes your tax dollars actually affected? The government has a very legitimate concern about retirement in America. And what they know is that if you as a business owner don't help your employees with their retirement, the entire burden will fall back on the government. And so this opens up one of the greatest opportunities in the tax code for business owners. And also, I found that most employers really do care about their employees. So it's with their help that they've been able to amplify their wealth building efforts and also create something special in the economy. And I've also found that once business owners learn about the options they have beyond 401k, they're much more likely to help their employees because this allows them to add additional layers where they can actually skew the majority of the company contributions into their own accounts. What kind of deductions are available for business owners? Just to give you one example, if a business owner were to start a profit sharing plan, they can put away up to $53,000 into their own account, not to mention the additional $6,000 if they're over age 50. Now notice, this is almost triple how much an individual can put inside a 401k plan. And since they're running a profit sharing plan through a corporation, it actually can avoid payroll taxes such as Social Security and Medicare, and that's a really big deal. So there's a lot of ways to design these, and there's been some changes in the law since the last decade. So even if you've heard of these or maybe even looked at it before, I would encourage you to do a feasibility study, take a little time, and see how the numbers stack up for your situation. Let's discuss an additional layer that you can do over and above a profit sharing plan. It's something called the defined benefit plan, or you may have heard of a cash balance plan, which is just another type of defined benefit plan. Now this can be done on top of a profit sharing plan or separate and distinct without a profit sharing plan. But in either case, these types of plans usually create six-figure deductions for the business owners. I just said on the low end, somewhere in the neighborhood of $160,000 to sometimes over and above $1 million, depending on how the plan is structured. Now again, it'll also depend on your salary, employee's salary, your age, employee's age, but it's something that should be explored, and a feasibility study and analysis is something that can be done very quickly by a qualified professional. The main thing about these types of plan is those dollars go in pre-tax, before state and federal tax and before the payroll taxes, and they also grow tax deferred within the plan. And just to show you the power of that tax deferral, we're just going to look at a simple example. What we're going to look at here is a really simplified example of a business owner having, say, $250,000 of gross income to put away. And in the green bars, they actually put it away in one of these pre-tax plans that we've been discussing and having it grow at 6% tax deferred, versus in the red bars, taking that same 250, lopping it in half, which in the state that I live in, California, can happen very easily, and then growing what's left, 125, by the same 6%, only not in a tax deferred environment. And just to further illustrate the point, I did use a very favorable tax rate. I used half ordinary income and half a capital gains rate. And what you can see just visually is the green bars are able to compound and snowball much quicker than the red bars. And that's because taxes are one of the biggest eroding factors of compounding, a very powerful force that Albert Einstein was fascinated and enamored with. And quite frankly, taxes is just one of these voluntary things that can just eat away at your wealth. And when you look at it just year by year, how much more wealth is being built on the green side versus the red side. Now, obviously on the green side, taxes will be due, but only as you take money out of the plan. Another point worth mentioning is all this wealth is being grown within a creditor protected environment. Let's discuss some of the ancillary benefits of these types of plans, also known as qualified plans. So one, we already brought it up, is the funds inside these plans are completely immune from creditors. They're off the table if you were to get sued for any reason. And what comes to mind is a famous football player that was accused of murder and was able to play golf for quite a while, living off of their NFL pension. And even though there was quite a big civil judgment against him, nobody could touch the funds inside that plan. Now, it can also help with tax-efficient business transfers. And what I mean by that is a lot of my clients have partnership situations or multiple owners, and there's usually a senior owner and a younger owner, and they're not really sure how that succession is going to work out or how they're going to balance things out. Well, these plans naturally tend to favor more chronologically advanced participants. And so if there is a senior partner, say, they would be entitled to a bigger slice of the pie. And this is a way to start to put into the equation of your long-term exit plan. And this part is going to be very tax efficient, not to mention creditor protected. And it can also help solidify continuity planning amongst partners. And the difference between succession planning and continuity planning is this is if somebody were to pass away prematurely before the exit. And a lot of people don't realize, but there's actually the ability to buy life insurance inside these plans to protect against a premature death. And you can also add provisions to make sure that that death benefit is tax-free. You can also add the provision to have a stipulation for tax-free post-retirement health care inside these plans. And last, traditionally, these types of plans are going to be within your estate for an estate tax calculation. However, if designed by the right professional, you can have this entire plan be completely outside of your estate tax calculation for that tax regime. Let's take a look at the sweet spots of the plan. Probably the ideal setup is where you have some highly paid owners with a younger and relatively small employee base. So remember, we have to do something for everybody involved in the plan. So if there's just a few employees and they happen to be young, it's amazing how much less these employee contributions will be compared to the amount of tax that would have to be paid if we did nothing at all. And there are situations where maybe there's a broad or broader employee base, but the employers are already making some sort of profit sharing contribution. What we ought to look at and see if it makes sense given the demographic to add one of those additional layers where the employers, the owners can boost up their contributions from 50 something to 100 something or 300 something or 500 something. And last, there's plans where employees are already getting a safe harbor match, and we find that these are usually bigger plans where it's not really designed to give the employer much of a benefit at all. It's more of a recruiting tool, and not all the employees are contributing to that safe harbor match, but it is worth looking at and eyeballing to see how much are you giving away with this match. And if we just converted this to a gift, so to speak, with profit sharing plan, would the owners be able to do significantly more? So again, if you have one of these types of plans and you haven't visited what's possible with design in a while, you're probably going to want to take a look at it and see if you can add one of these additional layers. There's some other really big reasons why you're going to want to look at what I call neglected plans. And the main one is oftentimes we can lower your internal plan expenses and at the same time get you a better, more comprehensive fund lineup for all participants, but usually my business owners are the biggest participants inside the plan. Another huge one are the fiduciary concerns. And this has been in the news for the last few years, but if you haven't heard about it, I encourage you to go to your favorite search engine and type in new 401k fiduciary rules, new 401k fiduciary standards, 401k lawsuit, and you'll see how big this is becoming. And this is a really big deal with the Department of Labor. In fact, they've increased the number of auditors specifically for these plans. So what you need to know is that if you're offering a plan, you as the plan sponsor are liable and responsible for things like reasonableness of fees, reasonably performing funds. It doesn't need they need to be perfect or beat the market, but it means that they need to be close to the benchmarks that they're trying to mimic or represent. And both of these go hand in hand with up here. By lowering your internal fees and enhancing your fund lineup, this actually better insulates you from a fiduciary standpoint. And last, offering true diversification, making sure that your participants and you have all the major asset classes represented here, and not just 17 different funds that basically have all been doing the same thing. We've talked a lot about qualified plans. Let's talk about what's possible in the non-qualified arena. And the key point is you can discriminate who gets to participate. So you can do a plan simply for owners if you want, or you can do a plan simply for key employees. You can do a plan for each, as long as they're highly compensated individuals. And the nice thing about this is these plans have very high contribution limits, and they can be different for each person, for each plan. There's so much flexibility with design and funding. There's so many different ways to skin this cat. It's just too much to address in this video. But what I want you to know is, regardless of what you're trying to accomplish, whether it's doing something for yourself or doing something to retain, recruit, reward a key employee, we could design a plan that's going to make sense for them and make sense for you from a tax standpoint. If your business exit strategy is, say, somewhere between 2 to 12 years out, you're definitely going to want to take a look at how non-qualified plans can play a part in this. And with familiar transfers, and what I mean by that is transferring the business to family members, children, or maybe even doing an inside sale to key employees, layering in different non-qualified plans can actually help reduce the total taxes due on that transfer. Now, on the other hand, with a third-party sale to a competitor or an outside buyer, by customizing non-qualified plans for key employees can not only help you build business value along the way and get a bigger price, but it will be more valuable to the buyer because you'll show you have a mechanism to retain these key employees through the sale. So I just want to briefly hit upon some of these often overlooked business tax opportunities, which may or may not apply to everybody. But the first ones are research and development credits, otherwise known as R&D credits, as well as domestic production credits. Now, unlike deductions, credits will reduce your tax bill dollar for dollar, and you can get them over and above deductions you're already taking. Now, again, the government wants to incent you to grow your business and spur the economy. And so if you're doing things that qualify for legitimate research and development or domestic production, that could be making things in America or making processes in America, all of these things may qualify you for these credits. So they're definitely worth looking into. Also, something called the cost segregation study. And this has to do with if you own business real estate. Depending on what type of real estate you own and the complexity of it, there may be a way to greatly increase or accelerate the depreciation schedule, giving you more deductions now. Also, there are training opportunities, and this is a relatively new phenomenon where the government, again, wants to see your business do quite well, and so they will incent you with tax dollars to train your employees to do a better job. And last, what I call the income or wealth shifting with family businesses. And this only applies if you own a family business or if you do have family. And this can tie into talking about stewardship of money and responsibility around money. If you do have children, whether or not they're performing services in the businesses, think about their talents and think about things they could do to assist your business in any way. A lot of young people are very tech savvy, and undoubtedly you have tech needs. That's just one example. But what I know is parents are going to help their children with money. So if they can take money away from the parents' higher bracket and pay it to the children's lower bracket for bona fide services, that's a win for everybody. We've looked at a lot of strategy, and you might be feeling a little overwhelmed at this point, or you might have already disqualified yourself from certain programs. And I would encourage you not to do so at this point. And I've designed a quick solution towards solving whatever challenge you may think you have. And I call it Feasibility Facts. It's a worksheet for business owners. And basically, it's a worksheet that you can go through on your own. And when you feel comfortable enough, it's something you can share with us that we can quickly eyeball and let you know which opportunities are going to be more viable for your situation than others. So don't forget to check your inbox for the next video where we're going to focus solely on opportunities for individual. And unlike the business sponsored programs, every single one of these plans is completely discriminatory. As always, don't forget to post your comments and questions. It really does help out other people who may have the exact same concerns. I hope you found a lot of value in this video, and I look forward to seeing you soon.